almost the last speaker, is the tax guy. David Poparad from the CPA firm Grennan, Fender, McCrady, Hess, and Poparad. I would encourage you when you have an opportunity to be in front of a tax guy, ask the questions. Okay, there's some good advice that can pop out of these. But David's going to hit some tax topics that are relevant and resonating right now, given the current climate post-election. So David is a partner at the firm, and we are glad to have him.
Thank you, Jeff. Just give you a background on myself. I've been in public accounting for 15 plus years for various local, regional, and national firms before this, so always dealing with businesses and shareholders. So I kind of enjoy the consultative approach with clients and getting to understand their problems and try to get solutions to their tax issues. So Jeff asked me to give a kind of tax reform or tax update on the economy and how it relates. And I started thinking through it, going, okay, what's relevant, most importantly? And what came out recently was the topical issues in the new economy and what to take advantage of, which with the new administration and things are changing, it may be difficult to plan for what to take advantage of because the way things are now may change. So I took the approach of, okay, the new administration's plan just came out. I think it would be beneficial for your business owners to understand what are they talking about changing and to be prepared for those changes. So I'm going to go through the Trump's outline of his tax plan, kind of give you an idea of what's there, what they're talking about, lowering the individual tax brackets to 3, and we'll get into that, removing a lot of the itemized deductions and increasing the standard deduction. The corporate tax rate will change the pass-through, which I imagine most of you probably are pass-through entities, and how that will affect you individually as shareholders and business owners. Expanding some of the child independent care incentives, AMT changing, AMT preference items that are changing. And one thing to note, there was no border tax or wall or how we're going to pay for that. None of that was noted in his outline. Then there's also, they're talking about cuts and simplification. I put simplification in tax, it's kind of somewhat of an oxymoron for the sense of it's so complex, how are you going to make it simple without, and there's so many lobbyists and special interests, it's going to be very difficult to make it simple in my mind. So what we got here is, on the left is the current tax brackets for individuals for married filing jointly, and on the right is what they're talking about bringing them down to the 10, 25, and 35% tax brackets. Now, the numbers up there, the 233, are my guesstimates. They did not release what each of those brackets are going to entail and where the income's going to lie. But it's going to be interesting in where they try to put those 3 tax brackets and in what income rates, level of income they're going to be. But going from, well, they got the 6, 7 there to 3 is going to be a shift. And then how do they continue to support the government on that? And we're getting to that too. They're talking a lot of cuts, and I'll put some numbers to it. Okay, you're asking for a lot of cuts. Okay, now how are you going to recoup that revenue to support the government? The main reason is increasing economic growth. How much economic growth is going to bring back $2 to $3 trillion for things they're talking about spending? It's difficult for me to get my hands around and understand how they're going to give these much tax cuts and still maintain the government the way it is, or what's going to get cut. So, deductions. Plan would eliminate most of the itemized deductions, with the exception of mortgage interest and charitable donations, which it's interesting, most of my clients are able to itemize. It's a combination of all their itemized deductions that allows them to get above the standard deduction. So you do have the mortgage interest, you also have the real estate taxes, the sales tax, the charitable contribution, some of miscellaneous deductions. All those add up to get them above the standard deduction. If you remove all of them, except mortgage interest and charitable contributions, I would say most clients will not be able to, most taxpayers will not be able to itemize unless they're really leveraged in a high interest rate and they got shot or give a lot of assets away and donate. But the ones, loss of itemized deductions are the one listed there. Above the line tax deductions would also be eliminated. That's things like your moving expenses, half your self-employment tax, and alimony maybe in there. Your traditional IRA contributions are there. They're talking about leaving that. So a lot of those things will change, and then the earned income tax, child tax credit, American Opportunity Tax Credit would be targeted as well, which that's about $150 billion, or was it $102 billion that was refunded last year in those bottom three credits. That would come out of the economy by not having that government support or subsidy. Elimination of targeted tax breaks. The carried interest is with limited partnerships. Partnerships start, you have one guy invested, gets money from others, they get paid upon the exit. So that would be one way that would be eliminated. And preference items would change from an AMT standpoint, real estate taxes, your incentive stock options are in there, depreciation and miscellaneous deductions. This is kind of interesting. They're talking about repealing the net investment tax of 3.8%, which there's another act out there that just would pass the House that basically said we're going to eliminate that as well. So part of the Affordable Care Act, they'll slowly just try to chip away at it, I think is their approach. And the capital gains and qualified dividend rates would remain the same. I don't know if everyone knows, but the bottom two tax brackets at 10 and 15% from that first slide, the capital gains rate is 0. The next couple tax rates are at 15%, and then the top tax rate, the 39.6, is at 20%. So when you bring that down to 3 tax brackets, how are they going to break up that 0, 15, and 20%? It's going to be interesting how they do that. Now with businesses. And business was a real big part of the administration's plan, and okay, how are they going to cut business taxes? C corporations, they would cut from the top tax bracket at 35% to 15%. And it's an aggressive thought, because that cut alone would do a $2 trillion cut to the government. So over the next 10 years. So that's, I mentioned earlier, what's going to make up that economic impact? Is that going to stir enough economic growth to get that money back into the government? As corporations how many are pastors? I assume most of everyone is. This one's the same thing, the tax rate would come down to 15%. And upon distribution, there'd be a second layer of tax, is what they're talking about. So that's probably the individual rate. So now you get into a C Corp structure almost, where you have a double taxation. Because what they're talking about is, okay, if you leave the money in the company, you're going to only have to pay 15% tax. Which is good. Okay, it spurs economic growth, reinvest in your company, and hire more people. But what if? Matt, as a shareholder, okay, he makes $1 million. And then he took a $100,000 salary, or $125,000. Now he needs money to pay the taxes, all that's passed through to him. Well, now you got to make a distribution for the shareholder so you can pay the tax. Okay, is that at 15%, or hey, is it more double tax? They're not talking about that, or how that will interact with the current tax code. Then reasonable compensation is, with pass-throughs, it's always an issue. How much are you making in salary versus you taking in distribution? That issue will come over to the forefront, because remember, you got that kind of double taxation a little bit, is what they're talking about. So are you taking more in distribution so you don't have to pay that double taxation? That point. Makes sense?
The distribution, I'm going to pay double tax, right?
In this way, you would.
Yeah.
So you increase your salary, so you're going to have the distribution. So once you get over the That Social Security limit, you're only paying it through 2.9% of payroll tax. So more in salary, less in distribution, so now it goes, okay, are you have unreasonable compensation because, you know, a reasonable comp fee is only 100 grand, but you're taking out 500 grand in salary. Is that?
Okay. Yeah, I thought you were saying the other way around.
That's how it usually is. Usually it's more in distributions and less in salary. This would change that, reverse that. Any other questions on that? Bonus depreciation. Bonus depreciation is available this year at 50%, and then 40%, 30% for the next 2 years. And Section 179 is all permanent now, so that's not much of a change. But they would discuss making more of the bonus depreciation permanent. At what level? The 50, 40, or 30? They're not really being specific about. And bonus depreciation is where you can write off 50% of the acquisition cost in the year you acquire it, only for new equipment. Things that are not addressed, the R&D credit, the 100% gain exclusion, which that's only related to C Corps. So if you're thinking about starting a new company, a C corporation and you plan on exiting within 5 years, because that's the holding period, it may be something you want to explore, because then you get 100% gain exclusion on that. And there's other little guidelines to that as well. S corporation converting from a C to S, they're not talking about changing that, and energy tax incentives.
Dave, could you speak to the R&D tax credit, because there are some folks in this room that I think where that may apply.
So the R&D credit, if you're experimenting in any way, meaning you're doing some at trial and error, and you're spending money on developers or a process, whether it's internal or external, there has to be a risk of failure in some way in the process. So the credit is dollar for dollar against tax. It applies if you spend, say, $1 million for R&D expenditures, which is salary, supplies, material, facility cost. You'll get about $70,000 of a credit as a rough estimate. It may be more, it may be less, but that kind of gives you an idea. So is that kind of...
So if I screw something up, I just say it's R&D? I'll document it, though.
I bet you would. In your process, it would be probably a software or something that, hey, how's it help you market? How's it help you do the internet better, get your product to market? So is a software development that said, hey, this will do the SEO 20 times better than anything that's out there right now, and it's all automated. So I'm going to pay 10 programmers to go develop this for me, and I'm going to take the risk. The taxpayer has to bear the economic risk of all this. I mean, if I wanted to do it, say, Bernie, here, go do this software for me, go build it for me, and you go, how much will it take? You go, 10 grand. I go, 100 grand. And you go, that's all I'm going to pay you, you go do it. And you go do it, but it takes you 300 grand to deliver the product. I didn't bear the economic risk. Now, if I go, you say, oh, it may take me 100 grand, but they come back and hey, I need 25 more. I need 25 more. Now I'm bearing the economic risk. So that's the difference. You can't outsource your R&D, but the taxpayer has to bear the economic risk to get the credit.
But still, how do you define what is actually R&D? You know, like I bought a $5,000 software program, to sort of organize and streamline our stuff, and I had a guy work on it for 6 months, and we finally just junked it.
Yeah.
Is that an R&D?
It would have to be part of the development process. So what's that software?
That's what we were trying to do, is like track our inventory and streamline our rental inventory.
Partly, yes, possibly. But most of the cost is just that one individual, right? It's not like you pay to develop the software.
No, but there's a lot of time in inputting and programming it to tailor it to our company.
And yeah, if you're customizing in that case, yes.
So, I mean, you
So,
know,
yeah.
I can name something I do every week.
And you could, it's just, are you putting the dollars there that are substantial to the credit? You may want to, most of my clients, that they're spending hundreds of $1,000s a year because we're going to get in a study, and so it costs an R&D specialist to go get the study, so it's documented. So when they get the $125,000 credit, and the IRS comes knocking on the door, they just go, here's your study, here's why it applies. And in your case, you may have to do the same thing, or you're just spending $10,000 to $20,000. Okay, it's R&D, do a rough sketch. I'll take the risk of putting it on the form. I know the rules, I went through them, I think it applies. You're not gonna go through the full-blown study because it's probably not cost effective. For the 30 grand that you spent, for 40, you may get, a $2,100 credit. You're not gonna spend 5 grand to get a study done. So you may just say, it all qualifies, I can document if the IRS ever comes. That's something we work through with the taxpayer. Most of the time, it just doesn't. We probably don't take on that risk. It would be something, hey, if you're willing to do it, we explain the rules to you. If you as a client want to do that, that's on you to explain. We document that in our files just in case. We don't want you coming back, 3 years later to get audited and it got removed, and then you got penalties and you can run out. But we can go through the rules with some of it. It's
And share about the new rule from the end of 15 to the under $5 million business.
If you're under 5 million, and you're generating losses, the R&D, you can't offset your payroll taxes with that. So it's a benefit. You may not have the income tax offset, but you can use the R&D credit to offset your payroll tax liability, which can be advantageous for businesses that are just starting out. Something to keep in mind. International, they're talking about one-time repatriation of profits. This next one, the territorial regime versus worldwide, is interesting. Right now, the U.S. tax code is based on a worldwide system, meaning it doesn't matter, you're a U.S. citizen, it doesn't matter if you live in Chile or the U.S., they're going to tax all your income. The money you earn in Chile, they're going to tax everything. And the rest of the world is more of a territorial system where if you live in Chile, hey, you make that money over there. That's taxed over there. Once you're in the U.S. and you're making money, that's only taxed in the U.S. So there's a different approach to a worldwide system versus a territorial system. But it's interesting to kind of change that. Kind of wrap it up. So what can you do today? So part of my presentation here is just inform you if things are changing. So how can you plan going forward in 2017 and towards the end of the year? If things are continuously changing, it's hard to make tax planning efficient. So, but if you know where you're at today, and you know your numbers, and you know your KPIs, and you know exactly where you're at, when things change, you can react accordingly. You can plan. So, there's always tax planning 101. Postpone your income, accelerate expenses. That's always there. That's always proven tax plan. With the change with distributions, you may want to distribute everything now and then loan it back to the company. There's thoughts to that. So now when you're doing S-corps, you don't have distributions, you just have a loan repayment. There's interest in, okay, it's debt versus equity, and that's what the new regulations are in 385. So we may have to take that into account where, okay, we got to document the loan, make sure it's a note, there's interest, there's an amortization schedule, those types of things. Give to charity, harvest losses. If you have gain and there's capital losses, you can generate now to offset that gain. That's always good. Donate to IRA distributions. Probably no one's there yet because usually you come to those when you're getting your required minimum distributions and you don't need the money, so the client just gives it directly to their church or favorite charitable organization. Contribute to your retirement plans, and Roth conversions are always good there. So retirement plans are kind of low-hanging fruit as well to defer income as well. Again, know your carryovers. Know what you have going in to 2017. What weren't you able to take advantage of in 2016 that may apply? Know your carryback opportunities. If you generate a loss here in 2017, hey, can you carry it back to 2015 and 2016 and recoup some of the prior year taxes? There's always opportunities there. Know your investments. How are you treated in your investments? All you are in your business, you're active, you're non-passive. But if you're in a rental property, that's passive. How many passive losses do you have? If you sold that property, you could free up those losses and offset your income. So knowing the treatment, knowing your carryovers. And just know your estimated income tax liability throughout the year. As things are changing, where are you at? Where do you stand? What deductions can you take advantage of? What is there for you? So if you know where you're at and where you're going, you'll be able to plan better for it and make decisions on the fly without having to research and gather the information. So that's always important too. Tax reform will likely to occur in 2017, what they're saying, possibly 2018. So know where you're at, know what's going on.
So 17's not gonna get hit, you say?
2017, 2018. It'll probably be this year or next year is what they're talking about, if it happens at all.
So it could affect, it could be retro to 2000.
It will be retroactive. So, in the outline, they're saying everything will be retroactive to January 1st, 2017. Yes, sir.
Okay, I'm a little bit in shock here. Let me make sure I understood. Did you say that they're talking about getting rid of the alimony deduction?
No.
Oh, okay.
Well, above the line, wait, I take that back. Above the line deductions are in there as alimony, yes. So they're talking about many deductions that are above the line, that would fall in there.
And then like IRAs? You don't-
IRAs will still be there. They're talking about eliminating most of the above the line deductions, which that's where your IRA deduction is. If you're contributing to a traditional IRA, that's where your $5,500 is deducted. And also your alimonies are deducted above the line. Removing expenses are deducted above the
So
line.
alimony could go away as a deduction.
As a deduction. It's very vague in the outline.
Does that make sense? Because you're paying it.
It's very vague. It's just a statement of most above the line deductions may go away.
Okay.
It doesn't get specific in which one, except with retirement plan.
What about losses? With corporate losses, you'll still be able to apply those on, yes?
Yeah, as long as you have basis. And you're at risk. Again, a lot of things are changing. That's why it's kind of interesting to say, okay, in the economy, in planning for 2017, if they keep changing stuff, it makes it difficult for your business owners to plan accordingly.
Plan.
Yeah, but something you need to keep abreast of and understand, hey, if they change this, how am I going to react? If things remain the same, how am I going to react?
So who's it gotta go? What's the vote? It's gotta go through the Senate and the House yet?
Yeah, it's just an outline at
Sorry.
this point. What they did talk about what passed the House was, the House just passed last week, was getting rid of the net investment tax, changing the medical deductions to 5.8% versus a 10% of adjusted gross income. There was a few other things as well, but so they're chipping away at the Affordable Care Act and some of the tax elements on it. So, will it pass the Senate? Probably not. Not in its current form. We'll probably go through some Reconciliation Act, and then who knows where it's going to end up. But it's interesting that these things they're talking about are significant changes. It's just not like it's bonus depreciation changes and maybe you get to write off more deductions. They're talking about changing the whole
Doesn't seem like
major
it's
tax
bad.
reform.
No, I was just gonna say, I'm very impressed you got this much out of a double-spaced single page.
Yeah.
Yeah, Dave, speaking about this, this C treatment of an S corporation going forward, especially for those companies that are transitioning their ownership internally, and the tax costs that implies, especially if it's kind of like a C corp treatment, and how you get the money to the key people or the family members. It sounds problematic. What are your thoughts?
It can be, depending on the tax structure and how you want to move that, call that succession plan to the next key management or key individual in the company. So is it internal, is it external? Do they sell the stock? Do they buy the assets? It's how much does the key shareholder want to exit what's his number to retire and what's he comfortable at? And then how much do you want to give away to people that, hey, it's been part of his business for 10 years and hey, they know my business, they're going to succeed at it. So it's kind of a balance between, okay, key shareholder's going to wants this, going to pay this much in tax, but hey, Joe that's coming in may not be able to afford that. So how do I help him out? And maybe it's an installment plan or installment payments over the next 10 years or something like that. We can get it to work out structured the way it's a win-win most of the time, if people are reasonable and want it to work out. And there's some risk too. So usually key shareholder, major shareholder, they don't want to keep risk going on with someone else that they're not in control. There's other ways you can control that by saying, hey, I'm going to give you common stock and I'm going to give you non-voting shares and I'm going to retain all the voting shares as a key shareholder. And that way they participate in the upside and if there's another exit down the way, but hey, the key shareholder is still in control until their note is paid off and they get the money they want.
Just a thought too, who here owns their own building or will? Speak about the cost side.
Cost segregation studies are, how long have you been doing?
Since 99.
2005.
So cost segregation study, non-commercial, non-residential,
Non-residential.
non-residential. Okay. So they depreciate over 39 years. So usually when you buy a building, you put on a depreciation schedule, it's land and building. The building's over 39 years. Cost segregation study comes in and says, okay, I'm going to break that building apart because, you know, this electrical is known as manufacturing equipment, this computer, and it's doing this big machinery and stuff. So I'm going to depreciate that over 5 years. You know, something similar like that. It breaks down all the structure of the building. Okay, what's the purpose of it? So it breaks it down from a 39-year property to a 3, 5, 7, 10, 15-year property where you can accelerate the depreciation. And also, you go into the building for 10 plus years, you do the accounting method change and say, okay, if I did the cost seg in the beginning, I was able to accelerate this much in deductions. It comes back in 2017 and says, okay, I'm going to take that huge deduction in 2017. You get the cost seg done and say, okay, this is what your depreciation should be if you would have done this.
And that's now or that's
No,
proposed?
it's now.
That's now.
That's the one that first year. So, but go through the study, the engineers involved, we have people that help us with that. And give a report, same with the R&D. Get a report, here it is, there's where it comes in, there you go. So it breaks it down. I mean, they'll take a building and break it down into, it's the last one we did for a hotel or apartment, it was 4 buildings, and it was 2,000 lines in the depreciation schedule. So they get detailed. But the time value of money doing that deduction today versus 39 years.
Well, I mean, I'm just thinking because not quite 2 years ago, I mean, I replaced the roof, that's $140,000. That's not 39 and a half years either.
Right.
And that was actually 18, 19 years. So, I mean, it seems like I'd be able to depreciate the roof over a faster period than 39 years.
That's probably still be 39. The question I would say, Matt, is okay, when you initially buy your building, then you got the building and you got your roof on there and your depreciation schedule. When you initially bought the building, there's still a roof on there. So there's tangible asset regulations 3-4 years ago that basically said, okay, you can break that roof off that original purchase and then write that roof off of the undepreciated amount.
Or you just write off the expense of the roof as an expense.
And then the roof and some of that, sometimes it's okay as a catch. If it's a membrane roof, I think you can write that off right away. Because that's not, they don't call that a structural improvement. It's a little bit of a gray area if it's evaluated the way that you support it. But if it's a full roof and shingle and you're ripping everything off and putting everything off, the membrane stuff, you can get away with that.
Right, there's no risk.
Yeah. Got it? All right.
Great stuff. Thank you.